Hey everyone, Brian Bogner and Greg Towner here with Parallel Portfolios, and we're going to talk to you about what does this upcoming election mean for the stock market. And this video is going to be a little bit longer than we normally do because we think this is very, very important. This election is really important that's coming up, right? There's no doubt. And it doesn't take very far to see how divided, obviously, the country is right now and just where we're at. But we need to be very, very, very careful. And this is what we're going to be talking through here over the next few minutes on what is going on politically and what is going on economically and in the markets and where those two actually intersect and don't intersect. So please pay attention, watch through this, and let's go ahead and get started. So the first point we want to make to you is that when you own a stock, what is it that you actually own? Because a lot of times, people will say to me, well, if this happens and if this person gets elected or this thing happens or then, stock market's just going to do this and the stock market's just going to do that. And the stock market's, well, what is the market, right? It's a group of companies. When you own a stock, you own a piece of a company. And what is that company? It is a group of people, right? Professionals, and what they come in every single day and they're trying to create value. They're trying to create value for their shareholders, for their clients, for employees, and they're trying to maximize that. So what do? When things happen that, maybe this person gets elected or this thing happens or what, they figure out ways to adjust. They figure out ways, sometimes there's massive headwinds, sometimes there's massive tailwinds. But you have to be really, really careful when you make this statement of, and when I say you, I mean we all do this. When we make this statement of, well, the market's just going to react this way or the market's just going to do that, well, these companies make a lot of money. And people get paid a lot of money to make sure that they're doing the things that they're doing right. So just remember, when you own a stock, you don't just own some inanimate thing out there. You own a piece of a dynamic, live company that, regardless of what the headwind is, they are trying to maximize value and can adjust with what's going on there. Okay? All right, Greg, what do we got here in this pretty chart?
Yeah, we thought a good starting point would be to just look back over time. This goes back to 1872 to see what stocks have done under the different presidential cycles. And so we can see the dark blue line is the Democrats going through this whole time. Strong performance. The dotted red line is Republicans, still very much positive performance, not as strong, but still very positive. One thing we also really wanted to point out here is this yellow line. This is first terms. This study that was done by Bank of America Merrill Lynch, they found that the market really liked a change of power in the presidency. And in particular, they liked the first year in that first term, performed quite strongly. If we go back, even going all the way back to the 1870s, it's still only 27 different presidents. So statistically, we have to take this with a grain of salt. It's maybe not enough cycles to know for sure. But what we do know is that under any type of presidents historically, we've ultimately seen positive numbers.
Yeah. And again, I think a lot of people, there's this mindset that Republican presidents are better for the market. And the data, again, and we're going to talk about this a little bit later, but you can just see here that Democrat president, the market's actually done better during Democrat cycles. So that kind of brings me to the next point here, which is that, we were talking about companies. Now let's talk a little bit about politicians. Never underestimate a politician's motive for self-preservation. Because again, whether you're a Republican or Democrat, okay, you run on a platform, you get into office, but once you get elected in there, you're trying to do what's right for the country, okay, based on your platform. But let's be honest, you're trying to maintain your power. You're trying to stay in office. So the idea that you're going to come in and just start, cowboy shooting whatever you want to do and this and that, and if it has a negative effect, then one of the things that we've seen with this country is there's a good chance you're going to get voted out at the end of your term, and you don't want that to happen. So I think one of the greatest political strategists ever, again, whether you agree with it, James Carville, he made this statement: it's the economy, stupid. And there's a lot of data out there that shows when the economy's going well and the markets are going well, whoever's in power typically stays in power. If it's not, typically they get changed out. So we want to be really careful when we start thinking about this upcoming election and saying, well, if this person gets in, oh my gosh, they're just going to da 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 da. Well, their very, very motivated to do what they need to do to stay in power. And a strong economy and a strong market is a big, big part of that.
Yeah, another thing that we've been hearing, Brian, is concern around, well, what if the Democrats win both the White House and all of Congress? You know, if you look at some of the betting odds sites, that the chances of that seem to be increasing, of course, and we'll find out for sure in a few months. But if you look back historically, this goes back to the 1950s, when that's occurred, Democrats in control across the board, it's actually been quite strong market returns. We only had 3 specific years where stocks were down, and the average returns were substantially higher than normal market returns. So again, very small sample size. This doesn't mean that if it happens, this is what's going to happen, but just means, hey, maybe you shouldn't be super afraid of it, because as we're going to talk about, there's a lot of other important things going on.
Right. Yeah.
And to that point, I mean, the government is really only just one of many factors, right? I mean, there's, of course, right now we have the virus going on, but even during so-called normal times, you have, you know, the regular business cycle that's so important. You have the demographics, you have the Fed, you have all kinds of themes. I mean, a long list of factors that we know and many that we don't know that are affecting stocks at any time that are hugely important.
Yeah, and usually there's some type of secular theme or trend or something in there that trumps anything that a politician's going to do, because that thing is so strong and so powerful. And to your point about even where we're at right now, quantitative easing and super easy money and low interest rates and things like that. You know, a lot of times that, regardless of what any politician does, that trend is so powerful that it tends to, you know, oversee that.
Yeah, and to that same point, I mean, think about, there's a lot of concern around, well, what if taxes go up? Well, if we look at 2013, there was actually a big tax increase on the individual side. The stock market was up over 30% that year. In 2018, there was a big corporate tax cut. Stocks were actually down that year. And why was that the case in both of those cases? It wasn't necessarily because the market liked or didn't like taxes. It was because there's so many different factors affecting things at once.
Right. Yeah, and again, kind of to that point, so this goes back to the 40s, and this simply just shows you the S&P 500 during that time frame, and shows you when Democrats were in, you know, controlling the presidency or Republicans. And first of all, what you end up seeing is almost a steady, you know, flow of blue to red to blue to red to blue, you know, over that time period. Okay. And, but again, to the point of, you know, like, oh, well, you know, Republicans tend to be better for the economy and better for the market. Well, I mean, if you look at the 70s here, when Republicans were in power, the market didn't do so well. And it was very volatile and went sideways. With, again, there was a lot of other factors going on, inflation, you know, the oil crisis, all these other things that were happening in the 70s that, regardless of who was in power, right? I mean, if you look here in the late 90s when the market was really booming, right? Was that because Bill Clinton was president, or was it because we were experiencing this amazing technology boom that was driving the market higher? But I think the important thing to take from this chart is that these things change. And if you look, the S&P 500 is starting in the lower left and it's ending in, you know, over time, it goes up. Yes, we do have these volatile periods. And that's one of the reasons why, you know, we talk about having a plan and staying in, you know, staying in and really looking longer term and not reacting emotionally, because over time, regardless of who is in power, the market does, you know, tends to absorb it, deal with it, and move on and move higher.
I think this next one is a very important thing for investors to consider right now, because we're hearing more and more from people, you know, hey, I'm more concerned, maybe I shouldn't do anything with stocks until after the election or what have you. But remember, the stock market discounts things way ahead of time. It's already looking ahead. I mean, we've seen that this year. The market's clearly looking past the coronavirus and the economy and so forth. So in our view, the market seems to already be factoring in a Biden victory. For better or worse, the market seems to already be factoring in. And why are we saying that? Number one, if you look at the polls and the betting site odds, Biden currently has a greater than 60% chance of winning. Number two, there's an institutional survey done looking at institutional investors over the course of the past year. It started the year where it gave Trump an 80% chance of winning. Now it only gives him a 39% chance. So those institutional investors are already saying, hey, we think there's a low likelihood that Trump wins, yet the market's doing what it is. And perhaps most importantly, if you look at areas of the market that are highly correlated to a potential Biden victory, such as renewable energy, those have done phenomenal in the last couple months as you've seen Biden's poll numbers go up. So to us, the market has factored in a lot of a potential Biden victory. Now, obviously, it doesn't mean it's going to happen. We know polls can be off and what have you. But in theory, if the polls were correct, it seems like the market has started to factor that in. But what if we even had the news? I mean, what if we had the newspaper from November 4th, the day after the election? Would we then know how to react? I don't think so. Because look at back, if I gave you today's newspaper from August, if I gave it to you back in January pre-COVID, would you know what the stock market had done? Or, I mean, you would think the economy has just crashed along with the stock market. And of course, we know stocks are back to roughly even. So just because you know the news doesn't mean you know how to react. And we certainly don't have the news. So keep that in mind as you think about what may or may not occur right after the election.
That's a great point.
You know, to the extent you want to try to predict a little bit, historically, in the 3 months, which we just started prior to the election, if stocks are up during that period, 80%, nearly 90% of the time, the incumbent party wins. And if stocks are down during those 3 months, then it's just the opposite. So, you know, to the extent that's more of a fun thing than a prediction thing, but just as you follow the market over the next few months, historically, it tends to tell you who might ultimately win.
Yeah. All right, so let's go ahead and summarize this. Again, you know, key point is when we talk about the market, let's remember what we're talking about. We're talking about companies that employ people, very smart people that come in every day and have a lot of resources at their disposal to figure out how to adjust based on, you know, what political party's in power and what's going on in Congress and what's going on in the world and things like that, okay? So many times they're able to adjust. With the market, we say this a lot, the market likes certainty, because when there's certainty out there, whether it's good or bad, when there's certainty out there, you're able to adjust and figure out how you're gonna make a decision. It's uncertainty that the market doesn't like. Our prayer here at Parallel is that, you know, the night of the election, we know who the winner is one way or the other, okay? Because then there's certainty. Politician self-preservation, do not discount that. You know, I don't care what anybody says. A politician wants to stay in office and stay in power. So they're going to do what they can to do that. And a bad economy and a bad market is almost going to get, even all the stuff that we show you, it's going to almost guarantee that they're going to get replaced, okay? Government is only one of many factors. Like we said, there's so many other things that affect the market and make it, you know, whether it goes up or down. And the government's just a piece of that pie. It's not the pie, okay? And some of the data we're looking at, you know, stocks are looking out ahead and they may already be pricing in a Biden victory and getting back to all-time highs again. So again, just be very careful when you know, like we've showed you, Democratic regimes, I know for a lot of you that are watching, probably doesn't sound intuitive, but they've been very positive for the market. So just, you know, we want to go with the data, not with what we think may or may not happen, all right? And the reality is anything can happen between now and the election, okay? I love Greg's point of, if you looked at a newspaper right now today, 6 months ago, and you said, are you going to invest in the market or not? You would probably say, no way. I mean, there's rioting, there's a pandemic, there's all these things going on. You'd be like, heck no, I'm going to invest. Well, guess what? You would have missed out, right? Because the market's up, you know? You really want to be careful making those conclusions, all right? So I know this video is longer than normal. I know this election is going to be on everyone's mind. It's, you know, the circus, the level of this circus is about to really continue to grow here. And so we're here to talk about it. If you've got a question, please give us a call, shoot us an email. We're happy to talk to you about it. And again, thank you so much for watching.